Welcome to Sectors Up Close. I'm Elena Casas. Today we're going to look at the outlook for oil prices, and my guest is Jim Mitchell, head of America's oil analysts at the London Stock Exchange Group. Oil prices have moved steadily higher over the past few weeks as the market digests supply cuts by OPEC plus nations, as well as the escalating war in Ukraine. The market does also seem confident that this week's expected rate hike by the Federal Reserve will be the last this year, allowing the US economy to avoid further economic pain. But there are a variety of other factors at play, including China's sluggish recovery, as well as a slowdown in US shale production and moves to refill the US Strategic Petroleum Reserve. So where are prices headed? I'm now joined by LSEG's Jim Mitchell. Jim, hi, thanks for joining us. Let's start, if we may, with the supply picture. How successful has OPEC Plus been at keeping pressure on the price by cutting output?
Well, success has many facets. If you're viewing success as stabilizing the supply side of the market, I think they've been very successful. Their last 2 million barrel cuts are certainly getting the headlines, but it's some of the other stuff underneath that is creating this environment where prices can rise higher, like the US SPR not releasing around 285,000 a day, and Russia's refineries coming back online to the tune of about 1 million barrels a day.
Can I zoom in on what you said there about the Strategic Petroleum Reserve, which I believe is less than half full after fuel was released from there to help bring down US gasoline prices? What's been the impact of that on the market?
Well, we certainly saw the impact last year with the 180 million barrels being released. Remember, in April, May, and June, in that complete time frame, the U.S. released 26 million barrels from the SPR. In August, September, October, November, those 4 months, the SPR will be buying in, so injecting oil into the SPR to the tune of about 3 million barrels a day, or 3 million barrels a month. So not that significant. So the fact that they're not bringing oil out, but putting oil in, definitely has a sense to tighten the market a little bit.
Where are US shale producers in all of this? Some have had quite a difficult few months, haven't they?
Yeah, so especially the smaller independent producers, it's been kind of a toxic mix for them, and it's really 3 elements. One of them is the fact that oilfield service prices have increased dramatically. Interest rates have increased dramatically on them. And also, they're starting to be limited by the spaces where they can drill, generally known as their inventory. This only really is affecting the smaller producers, to a lesser extent, the bigger producers.
What about the demand from India and China, Jim, in the international picture? How much is that being fulfilled by Russian oil, which is sanctioned by the West?
So both India and China had record Russian imports in July. And then when you look at what's second and third, it's months like May and April. So India and China are substantially taking Russian oil. And why shouldn't they? If it's going to be at a $20 discount to the market and they don't need the U.S. Payment structure, why shouldn't they import it?
Given all of this, then, where do you see prices at, say, the end of the year?
So I'm not quite as bullish as some of the other commentators. I do see the supply tightening a little bit. I don't think we're going to see $100 unless there's some kind of supply spike. I do think we go a little bit higher than where we are now.
Jim Mitchell, head of America's oil analysts at LSEG. Thanks so much for joining us. And that's your roundup of the oil market. I'm Elena Casas, and this is Reuters.